Compensation. Definition, please. Let's start with definition of common terminology. Stockholders. They have executive pay of special interest. It is linked to company performance. Managers. They have compensation influenced in two ways: a major expenses and influencing employee behaviors and improving organization performance. Employees. The pay individuals receive in return for the work they perform, a return in exchange between their employer and themselves, an entitlement for being an employee of the company, or reward for a job well done, a return for their contribution and investment of time, knowledge, and competency. Sometimes labor costs can be more than 50% of total cost. In some industries, such as financial or professional services or public employment, such as education and government, the figure is even higher. The way people are paid affects the quality of their work, their attitude toward customers, their willingness to be flexible, learn new skills, or suggest innovations. Compensation refers to all forms of financial returns and tangible services and benefits employees receive as part of an employment relationship. Forms of pay. There is a variety of return people receive from work. They are categorized as total compensation and relational returns. The relational returns, learning opportunities, status, challenging work, and so on, are psychological. Total compensation returns are more transactional. They include pay received directly as a cash, example, base, medical insurance, program to help balance work and life demands, brightly colored uniforms. Programs to pay people can be designed in a wide variety of ways, and a single employer typically uses more than one. Cash compensation. Base. Base wage is the cash compensation that an employer pays for the work performed. Base wage tends to reflect the value of the work or skills and generally ignores differences attributable to individual employees. For example, the base wage may be $1,000 per month. However, some employees can receive more because of their experience and or performance. Some pay systems set base wage as a function of the skill or education an employee possesses. Cash compensation. Merit pay, cost of living adjustments. Periodic adjustments to base wages may be made based on changes in what other employers are paying for the same work, changes in the overall cost of living, or changes in experience or skills. Merit increases are given as increment to the base pay in recognition of past work behavior. Some assessment of past performance is made with or without a formal performance evaluation program, and the size of the increase is varied from performance. Thus, outstanding performance could receive an 8 to 10% merit increase 12 months after their last increase, whereas an average performer may receive a 3 to 4% increase after 12 months. In contrast to merit pay, cost of living adjustment give the same percent increase across the board to everyone regardless of performance. Cash compensation. Incentives. Incentives tie pay increase directly to performance. However, incentives differ from merit adjustment. Incentive tie increase directly to performance. However, incentives differ from merit adjustments. First, incentives do not increase the base wage and so must be re-earned each pay period. Second, the potential size of the incentive payment will generally be known beforehand, whereas merit pay programs evaluate the past performance of an individual and then decide on the size of the increase. The performance objective for incentive payment is called out very specifically ahead of time. For example, a Toyota dealer knows the commission on Land Cruiser versus a Corolla prior to making the sale. Although both merit pay and incentives try to influence performance, incentives try to influence future behavior, whereas merit rewards past behavior. The incentive reward destination is a matter of timing. Incentives can be tied to the performance of an individual employee, a team of employees, or a total business unit, or some combination of individual, team, and unit. The performance objective may be expense reduction, volume increase, customer satisfaction, revenue growth, return on investment, or increases in total shareholder value. The possibilities are endless. For example, return on capital ROC, for every quarter that a 6% return on capital target is met or exceeded, days of pay may be awarded. And 8.6% ROC means 2 extra days of pay for that quarter for every employee covered by the program. A ROC of 15% means 8.5 extra days of pay. Because incentives are one-time payments, they do not have a permanent effect on labor cost. When performance declined, incentive pay automatically declined too.